originally termed it acorns to unicorns. And as investors and limited partners that we are, basically accredited investors who would like to make investments, we found that the opportunity to access mid to late stage growth companies. Now, think when I say that mid to late stage companies, before companies become a public company, for example, Robinhood, Coinbase, Marqeta, SoFi, NerdWallet, Ripple, Dapper Labs, BitPay. These are all companies that we think of as mid to late stage. The valuations are from between $500 million to $1 billion valuation companies. And that's what we allow accredited investors to come onto the platform and then use our app.
That was Karim Nurani, Chief Strategy Officer at Linqto. In today's episode, Karim shares the origins of a platform built to give the average limited partner access to mid-stage and late-stage growth companies that have typically never been available before. Stay tuned.
The limited partner shares in the potentially outsized returns of a well-planned and executed investment, but as a passive investor, and has the maximum leverage on their most precious asset, their time. And that is why we're here together. 90% of the millionaires out there built their net worth with real estate. However, 0% of the billionaires are hands-on managing their real estate assets because there simply isn't enough time. My name is Jake Wiley, and for the past 16 years, I've been investing in real estate, and I've learned a thing or two. But the most important lesson is how to leverage the expertise and time of others to maximize your investment potential. Welcome to the Limited Partner Podcast.
All right, welcome partners again. This is your host, Jake Wiley. I'm really excited about this week's conversation because it's going to be a little different than we've heard in the past. I'm joined by Karim Nurani, who is the Chief Strategy Officer at Linqto. Karim, welcome to the show.
Jake, thank you so much for the introduction. Welcome to the audience and pleasure to be here today.
Well, I'm going to let you tee up kind of about Linqto because it is a little bit of a twist on what we've talked about in the past. But for the benefit of my audience that hasn't met you guys yet, give me a little bit of background on you and how you got to where you are and a little bit of background on Linqto.
Wonderful. So I'm going to start actually with a background of Linqto because that'll give us an idea of why I'm here after you hear a little bit about my journey. So in 2016 or 2017, I became an early investor in Linqto. At that time, we were building the back-end plumbing for regional banks and financial institutions that didn't have the power of the big five as we know it in the US. We were making money, but not enough to be a growth company that we don't like to believe that we're involved with to take it to the next level. So we retooled the infrastructure in 2019, and we built a financial marketplace platform, and we originally termed it acorns to unicorns. And as investors and limited partners that we are, basically accredited investors who would like to make investments, we found that the opportunity to access mid to late stage growth companies. Now, think when I say that mid to late stage companies, before companies become a public company, for example, Robinhood, Coinbase, Marqeta, SoFi, NerdWallet, Ripple, Dapper Labs, BitPay. These are all companies that we think of as mid to late stage. The valuations are from between $500 million to $1 billion valuation companies. And that's what we allow accredited investors to come onto the platform and then use our app. And it's as simple as point, click and invest. And you get a company of your choice out of a variety of, anywhere between 15 and 13 companies that we have on our platform to make an informed decision to make an investment. During the heyday of companies going public, we were fortunate enough to see about 30% of our companies go public, and depending on your investment choice, you were either making money, and if you still held on to them today, you might be losing a little bit of money. But the difference really is, as opposed to a brokerage firm where you're trying to buy secondaries on the market and become an owner, what we've done is we've already invested in these companies already. So we own the shares, and then we give you access to it through our SPV LLCs on the back end. And it was really fortunate for us to do this because access to these private companies, growth stage companies, was very limited to folks who had 30, 40, $50 million in the bank and had connection to Wall Street. And we said, no, we've got to change that model and create an environment where all of us as accredited investors can have access to these companies. And so we built a platform, and we're doing really, really well. Really, that sort of portends to my background as how I got here and why I'm so happy and fortunate to be involved with Linqto today. Is I started off very early after my university days as an entrepreneur, an investor in early stage startup companies. And you find that the opportunity are that most people will pay attention to is it within their educational background or their geographical background, and so your opportunities are limited to those environments. Whereas with a platform such as this, your opportunities are global. And as I started along this journey very early on as investor in early stage startup companies, it always annoyed me to a large extent that we couldn't have access to the prominent companies, Amazon, Facebook, Snowflake, et cetera, Uber. Why didn't we get an opportunity to invest in these companies? And as I look back in my life and found the opportunities existed for me within my environment, I decided that Linqto was a great opportunity for us to diversify and asset investments as an accredited investor. So for a long time, I did a lot of. I've sort of helped close to 100 companies who are in early stage startup companies either identify funding, or identify growth opportunities, or build out their teams for them. And this was a very strong learning experience for me throughout the number of years that I've been involved in this category of investment strategy.
Well, I really like kind of the platform and the idea that, one, you guys have invested already, right? So it's not just an exchange where people can go. So like, is it fair to say that you guys have already done some diligence, because that's something we talk about a lot on the show, is diligence on these companies, these investors, these opportunities, these general partners, these sponsors. It's really, really important. I'd love to get your take on that.
That's a great question. And that question comes up all the time. And let's put it into a couple of different buckets, right? So if you are an early stage investor, and when I mean early stage investor, I'm talking about the angel stage where you're putting in pre-seed, seed, or even Series A funding into a company that you resonate with their mission, you understand their industry, and you've done some due diligence on the founding team and appreciate that they have an opportunity for success. And that's great. Then we look at the companies that have gone to the right side of the scale that have become public companies. So we play right in the middle of that. Companies that are raising, they're either C, D, E, or F round. And so keeping in mind that by the time they get to a $500 million valuation, they're probably already invested into by prominent VCs and private equities. Think Andreessen, think, Sequoia, SoftBank, Greylock, any of these companies that have really put significant money into these mid-stage companies. What we believe is that they've probably done a lot of due diligence already, and we rely on their expertise. And we then identify the companies that within those environments that we think will be trending positively. So, for example, in the last 2 years, we've been paying attention to blockchain, digital assets, space technologies, and payments industry. And what we find is that a lot of these large-size VC companies or private equity have made investments in these companies. So the probability of success is much, much, much higher than a very early stage company that a lot of people are looking at to invest in. the statistics are, 98% of the early stage companies will fail. So you have to make a lot of small investments into these companies. And if you find one that's successful, your return is likely to be very, very high. What we've done is sort of done the middle ground, is in identify companies that are mid stage, late stage. So they've probably already raised 300, 400, 500 million. The probability of success is 85%, 70 to 85%. So you have to make less of a monetary investment, but there's still opportunity for growth when there is a liquidity event, whether it's through the public markets or through an M&A acquisition.
So as we think about, like, on this show, we talk a lot about cash flow investing, right? So we're investing in real estate that's kicking off cash. This is definitely different. What does the investment life cycle look like? Timelines, all of those factors.
Yes, in terms of categories of investments, you're correct. There are a lot of you've got to balance sort of where you want to be as a personal limited partner or investor, looking overall at your strategic investment cycle. There are opportunities, like you said, Jake, with cash throwing cash off on a regular basis. That's really great. Same with dividends, although the returns are, given what they are, limited in nature. And then you're looking at early stage investments where the opportunity of failure is high, but the opportunity for a huge return is also significant. And those timeframes are anywhere between 2 and 7 years, or 2 and 10 years, depending on how quickly they get funded and if they're targeting the right marketplace. And then if you look at what we're doing as mid stage to late stage, the time horizons bearing the current situation, we were looking at anywhere from 12 months to 36 months. That timeline may be pushed out a little bit now. Not to say that there won't be any M&As without IPOs. So you're looking to balance your investment in time horizons. 3 to 5 years, this is what you should be comfortable holding an investment in. And your likelihood of return is significantly more than a recurring dividend payout, or an investment returning you, 5 to 7% a year. So that's what. And if you're looking at the IPO market, then you're sort of in the middle of very, very, very high returns with a high success, with a high failure rate, to very low returns with a public company. So we're in between that level of medium term, but possibility of a great return.
Okay. So a little bit higher risk, bigger return. What, I guess, for somebody that's looking to get started, right? They've just stumbled upon this podcast, and they're like, wow, this sounds great. This is a great way to kind of diversify my portfolio. How would you recommend someone start investigating the opportunity and then getting their foot in the door?
Yeah, there are a couple of different things. I mean, what I'd really focus on is, the time now, the conversation is like, do you have a product or a company on your platform that makes sense to me? And I don't know. The response is, you should actually just go to linqto.com, take a look at what we have on the platform, see if any of the industries or companies resonate with your investment thesis. And this is an important part. Your investment thesis is the crux of your investment strategy. You as an individual need to decide what is your risk profile, what is your time horizon, and what kind of returns would make you comfortable. What we do find in the current market, and what we've seen, is a lot of people follow and chase the hype. So they're listening to friends and making investments that they have no idea or knowledge of, whether it's the industry, or the technology, or the future potential of it. And they chase that hype without understanding the investments that they're making. So I would recommend that any investor be very, very comfortable with what is the thesis that you're going with, and what is the kind of companies and industries you want to invest in. A very simple question. Would you invest in electric vehicles, having known nothing about the whole environment of electric vehicles, or power, or generation, or climate. I mean, if you don't know these things, then do you want to make an investment in that structure or in that environment, given that there's so many companies playing in that environment? So pay attention to what you're good at and what you like to do and what you'd like to research on. All of this takes time. It's not as easy as going to your broker and saying, "Hey, just pick me 10 companies." Uh, if it were that easy, a lot of people would be making a lot more money. You just have to do the work. We all have to do the work.
Yeah, I think that's a great point, and it dovetails really nicely with the conversations we've had on the show thus far. Your investment, like if you want a super stable, low risk investment, you're going to get super low returns and maybe non-existent returns with inflation. But if you want to up the game, there are opportunities like this. But you have to know what you're getting into. You have to make investment choices based off of your expertise, right? You can't just jump in. And I think that is something that I always stress. And I think the more conversations I have on the show, the more it really sinks in, is that there is no silver bullet, and things are constantly changing. And as I kind of think about constantly changing, I mean, the market that we're in right now is so drastically different than the one that was just a couple months ago. And I guess let's talk a little bit about that. What do you see? What do you predict?
Don't you just love predictions? They're always wrong, right? As I heard recently, I'd rather be a futurist, because whatever I say today, I could be right or wrong, but no one cares because it's a futurist
That's
theory. Right. So I'm not going to make a prediction. What I am going to say is this. Times are changing, and times have changed. And if you look at what has happened in the current market cycle, there has been a lot of liquidity by the governments as well as large financial institutions who have made money previously. And they were chasing a lot of companies and funding a lot of companies, early stage, mid stage, late stage. And a lot of these companies, what you find once you dig a little bit deeper, are chasing growth without an understanding of their revenue, right? It's like, hey, if we have more eyeballs, it means that these people will be customers. And certainly a lot of them may be customers, but the cost of having a customer sometimes outweighs the revenue and profit margins that you're getting from these customers. So yeah, you may be a rapidly growing company, but not making any money, and in fact, losing money every time you get a new customer. So as the liquidity environment crunches up a little bit and shrinks, what we will see is more and more investors paying more attention to, is this company viable that we're investing in? Do they have an opportunity to grow and actually make money with their growth, make revenue, so that at the end of the day, we don't have to keep funding the companies? And there are a lot of companies out there that have got huge valuations, a large number of customers, but are making no money. So the market is teaching us a lesson today that investments need to be looked at carefully. Due diligence we must pay attention to due diligence. And the teams, if the teams cannot weather a storm collectively, then the success of those companies are marginalized. And because there's been no stress in the market for a good 7 years, a lot of these teams currently have not been tested. And we'll see the test today and moving forward over the next 18 to 24 months, whether they can weather the storm and they can really actually show value in the companies that they're building.
Yeah, amen to that. I mean, the tide has been rising for about a decade, right? And that is a long time, and it's covered up a lot of mistakes. And there are a lot of folks out there that are young, that have never been through a cycle. They've never really had there's people that have gone full cycle on a couple, IPOs that have never made $1, right? They just spend money. They spend it really well. And, they're the unicorn out there. But the reality is that there are some business fundamentals that you got to get your brain wrapped around. Is like, is there really a viable plan to profit, which is super important? And does the management team have a path to get there? And that is completely in sync with every conversation we've ever had on this show.
And I would like to say this, though. The management team today, maybe the correct management team for the business today, but we have to also remember, as you're a rapidly growing company, the new team members or employees that you bring on have to be aligned and adaptable, because a growth stage company that has a 20 or $50 million valuation, and I think a $50 million valuation is when things change rapidly, and the team members that you bring on board need to adjust to the demands of taking that $50 million company to a $100 million company. Those are completely different skill sets and endurance levels that are needed with an early stage. And the enthusiasm and hype that you may have growing a company up to 50 million is probably not the same that you have to have growing from 50 to $100 million. So there will be a change both in management and team members to meet that growth and the demands of that environment. And management has to be able to make tough decisions about who their team members are. So we have to pay attention to how effectively the management also recognizes this truism.
Yeah, because there is, in early phases, you've got a founder and his bootstrap team. And, here's a team that collectively is just willing to get it done, figure it all out. And it's messy and it's ugly and they're proving the concept. But at some point, like what you're saying, maybe at $50 million, all of a sudden systems and processes and efficiencies become the thing, right? You can't push that much stuff forward manually. And you're right, it is a very different team. There's systems, there's things that need to go into place. And I think that's a really astute observation that we all need to be thinking about as we're looking at potential investments is, where is the company in this cycle? Are they getting ready to make this transition? Have they made that transition? Do we think the management team, do we think the founder, whoever's leading this can make that call, can actually get it done? Okay. So what else, what other, I guess, what mistakes have you seen people make investing here?
I would say, depending if there are mistakes depending on the stage of companies that you're making investments in. The most early stage companies, if you're investing in anything that's sort of like angel related, who have not really raised an institutional round from a top tier VC or private equity, you have to be very, very careful about the management team, the technology team, because let's be fair. Right now, most businesses have to have a very robust technology backend to be able to survive, and this technology will be constantly tested and constantly has to be renewed and ramped. And so the management team, whether it's the CEO, CFO, CTO, have to understand that there will be changes in sort of the mid to late stage companies. Early stage companies, the mistakes people make very, very early on is they don't do enough due diligence on the management team, nor about the status of the bank accounts, right? And a lot of people are afraid to ask these questions of like, hey, you want me to invest X dollars in your company, but tell me a little bit more about the $5 million that you've raised over the last 2 years. Where did that money go? And what does the financial status of the company look like today? There are a lot of people who are scared to do that because they feel like they'll be insulting somebody. But I wouldn't. Remember, your investment as a limited partner is your money. It wasn't easy to get your $100,000 or $500,000 that you want to invest. Why should you be giving it away without the correct due diligence, right? Why would you do that? So ask the tough questions. Don't be afraid. And if they turn you down as an investment partner, a limited partner, well, walk away, because it's not a bad thing. If they're free to share with you every point of success they've had, or even the point of failures that they've corrected, it gives you a little bit more confidence on the transparency of these investable opportunities. If you don't get that when you're writing a check, then what makes you think that you'll ever get that?
Yeah, I mean that is your chance to ask the question, right? Because once the check is written, you can't get it back.
Once the check is written, it's gone.
Yeah, I mean you'll be surprised at the answers you get, right? It's like if we had a ton of cash, we wouldn't be looking for investments, right? Like it's like,
Yeah.
okay, but I need to understand your plan. Like where did it go? How did you use it? How do you plan to use this? What are the sources and uses? Like what is the strategy here? And there has to be sense, as opposed to we just need more cash so we don't flame out, right? Because that's pretty common.
Even on your past track record, you're going to flame out in 6 months. You'll be coming back, and I don't want that to happen.
That's right. That's right. Yeah, just ask the hard questions, right? And I think the other thing that I always tell people is there is always another deal. There's always opportunity. Yes, there are the Facebooks and the Googles that just, went through the roof, but there are always opportunities. If you keep going and you get some reps and you ask questions, like you'll just get smarter and you will find yourself in front of the right opportunities.
I'll give you a very simple example, I think, and Jake, you will be able to resonate with this. When you go to buy a house, today is a different market. 6 months ago was a different market. If you were going to buy a house, you wanted to put as much cash as you could down to win that house. But take that scenario out, and what happens when you go buy a house, right? You go through the marketing cycle. You then go through the due diligence of the house. You look at the ownership. You ask for a pre-inspection report. You then go through the due diligence with your bank to get a mortgage. Think about all the questions that you're asking the seller of the house before you put down your $500,000. And then look at all the questions your banker is asking you before they give you a loan. Who are you? What kind of money did you make? Where did it come from? How do you spend your money today? And how will you service our loan, right? You just take that as a very simple example of you trying to spend money at the same time to get a loan, and the questions that you ask of the seller and the questions that are asked of you as an investor who's trying to raise money. Why wouldn't you use the same criteria for an investment that you're trying to make in somebody else's business? Just use that as a guideline.
Yeah, and I think that probably taking that analogy a step further is what questions have you asked to date with the investments that you put out there? You've got a 401k. Are you asking any questions about that? Or are you just throwing it in some sort of fund? I mean, I think there is a time where maybe you're younger and you're like, hey, I don't really have anything to lose and let's just go for it. But you brought this up earlier. Like it takes a long time to earn all of this money that you're going to go invest. And you got to be really careful with that. And you got to ask those questions. And I'm challenging every one of you guys out there to probably ask more questions. Ask something that you feel is maybe going to be insulting, not on purpose, but be willing to do that, because the answers you get will be so telling into where you were going to place your money. And if you feel like it's the right person, because you'll know right away when you ask an awkward question, if you get a really like terse response, you don't want to put your money there anyway. And that would have that would have answered the question in less than 5 seconds. But, we don't do that.
No, we don't do that. And the other thing I would pay attention to is actually listen to what's not being said when you ask a question. You may get a direct response to a direct question that you have, but also listen to what's not being said. Oftentimes, a very informative landscape is provided if you listen to what's not being said, and that's a good indicator.
Yeah, I like that too. I like that a lot. Well, I guess, Karim, is there anything else on that you feel like we need to cover for this conversation to be complete?
Yeah, I would encourage. Look, Linqto.com is we're democratizing access to mid and late stage growth companies. that ordinarily as a limited partner or as an accredited investor without mega wealth, there is no opportunity to access this. We've created this platform. We're really proud. We're doing well. We aim to continue to grow this company and spread the word that we're here, we exist, and we'd like to support you. I mean, the difference here really is from a lot of different companies. We're not a VC company. We're not a private fund company, which means I'm not asking you for your money and then we'll decide where to invest it. We're, as a company, already making the investments. So we've already got skin in the game. We then ask you to take a look at the choices that are offered up to you, and you can choose what you want to do with your funds and what kind of companies you want to invest in. But I would always, I've been doing this for, over 25 years now. And the most important thing I can say to you is your wealth belongs to you and your family and your children and your parents. And to ensure that you've taken good care of the basics, where you're going to live and how you're going to support yourself now and in the next 10 to 15 years. If you then have some funds that you'd like to deploy, start looking at the various alternatives, make a decision on what your time horizon is and what you'd like to receive back over the next 5 years. It could be staggered. I want to see X dollars come back to me in 3 years, 5 years, 10 years, and 15 years, and then start categorizing your investment thesis. There are a lot of opportunities out there, but really the work for any limited partner, any investor, is to do the work. None of it comes easy. And especially if it's your hard-earned money, you want to make the right decision. So do the work.
Yeah, I love that. It is so important that you do some work, right? Because I think a lot of us are tired. We have that full-time job and then they're like, I don't want to do more work. I don't want another job. I just want to put my money to work. But this investment is what's going to pay for you to live in the future, right? It's going to give you all the things that you're hoping for in retirement. So yes, make it work for you, but do a little bit of work. Help it out.
Do a lot of work. Actually, do a lot of work. We do a lot of work. I mean, you've seen the rug pulls and you've seen what's going on. I would tell you this. I mean, one of the things that people really underestimate is the research that you can do by your own. So if you start looking at Linqto platform and look at the companies and you're saying, hey, what's the due diligence? This is, look, if we look at the 15 other VC companies that put money into the company, that's a big bunch of due diligence. But before you make the investment, right, go in and research that industry, research that company that you want to invest in. And a couple of different things to look at that a lot of people forget to look at. It's like go on to their recruiting page, see what kind of people they're hiring, in which sector are they falling? Are they falling in sales, leadership? Take a look at who they're hiring and for when. That'll give you an idea of the potential trajectory of the company. Look at the products that they're offering and what is their value proposition, and then talk to your friends and do a quick message out to them. Says, hey, do you use this company? Do you understand who they are? Do you understand what they do? The other thing to do is look at if they're making significant transitions in their C-suite. Are they hiring different calibered financial officers or different operators or different technical people? You'll start to see a messaging with all of these social things that's available publicly to see where the company's going. Are they investing more? Are they changing their marketing message? Are they hiring more people? Are they laying off more people? Are they changing their C-suite? Look at some of these things that they're doing, and you'll get an idea of where this company is likely to be heading.
Well, I really, really like that. It's a golden nugget. Like, where is the company going? And how do you get a good idea of that? Is what are they hiring for? So you could start your diligence just looking to see like what jobs are out there. Thank you for sharing that. I really like that. That's a new one.
Okay, good. I'm glad I added something to it.
No. This has been a great conversation. But I like to end every show with a bit of gratitude, because we all got some help along the way. Somebody gave us maybe an extra leg up that we didn't deserve. But I want to give you an opportunity to publicly say thank you to somebody that maybe gave you that help along the way.
I would actually like to nominate a few people in my company who have done an outstanding job. Bill Saris, who's the CEO and co-founder of Linqto, very low key, probably hasn't made any social speeches, but amazing deep background in technology and leadership. He's great. There are a lot of things that he said are wonderful. If you look up Joe Endoso, Joendoso, our chief operating officer, a wealth of knowledge in the private markets and the public markets and all things related to investments. There are wonderful people who I've worked with for a long, long time now. And it's from folks like this that I learn a lot every day. And I think that would be the value to the other limited partners out there. Surround yourself with people that you can learn from on a daily basis, right? It's really interesting. One of the things that we're always tasked with from our leadership team is guys, make yourself redundant. Hire people who are actually going to put you out of your job. And it sounds horrible, but it actually, if you take it to what it means, it's what you're doing is the stuff that we do on a daily basis are things that we do on a daily basis. And we can't really get better at what we do if we continue doing the same thing over and over again. So hand over those reins to somebody else. Let them execute what you think you're good at. Let them be better executives than you can ever be in particular areas. And then hire and then move yourself to a level that is new, exciting, and that you can bring value, because you just constantly need to be evolving and growing, because if you're stagnant, and eventually you work yourself out of a job by being stagnant. So surround yourself by great people is what I like to say.
I don't know if you caught that in the intro, but that is really part of the thesis of this whole community is finding people to elevate your game. And then the whole put yourself out of a job has always been my life thesis. And I tell everybody that I work with, if you can get somebody to take over the work that you're doing today, it'll be scary because you don't know where you're going. But I was like, I can tell you from my personal life, every time an amazing door has opened up, but only when I've been able to close the door behind me. Yeah. And that is so powerful. It's scary, but you got to kind of step into this unknown. So I really appreciate that message.
Thank you, Jake.
Well, this has been an incredible show, and hopefully you can tell I really am excited because we're bringing something different here. We're not just talking about real estate syndications. There are other opportunities out there. I like how Linqto is democratizing this opportunity for us, where yes, we typically, you got to be a super high net worth, you got to be a pension fund to get into this game, and we have an opportunity now. So Karim, thank you so much for being on the show.
I appreciate the time, Jake. I really appreciate it. Thank you all, and looking forward to talking to you again whenever it's possible.
I hope you've enjoyed today's episode, and I'd actually love for you to contribute to a future episode. If you have a question you'd like answered, or a topic or a guest to bring on the show, please email me at jake@thelimitedpartner.com. Now I realize there's a lot of lingo that's thrown around on these shows, so I've created a cheat sheet for you with the top 26 terms that come up most often. Head on over to thelimitedpartner.com/lingo for the list. Enjoy, and we'll see you next time.